Welcome to another weekly market insight where we sift through the noise to get to the signal so you can have actionable advice and make informed decisions. Joining me this week is Chris, and we're going to be talking about the Fed. Last week we reviewed kind of what our projections are for 2022 as well as how well we did in 2021 or didn't do. And then we're going to go ahead and get into the Fed. What's a new dot plot?
So it's not that new, but this is from the December meeting of the Fed, and a median projection of their forecasts, they don't say their names, is 3 rate hikes for 2022, and most of them likely starting in March, so starting very soon. I think that the market is priced in about 90% chance that that's going to happen, that the rates will start. They have a meeting in January. No one's expecting rates to increase then, but March.
But whenever they were looking at this, I look at the gray line, which is kind of where the market was at that time, projected to the median. The market's moved a lot since then. So what that tells me is that the market is taking the Fed statements this time seriously, because they're always going to say we're going to raise rates sometime in the future, right? So that the market is responding off of that and moving up tells me that the market is starting to take them seriously, and we've seen that in the movement of the market.
Yeah, actually, Jim Bullard, the Fed president of St. Louis, actually spoke in front of the CFA Society of St. Louis last week, and he said he was one of the three rate hikes, so he wasn't one of those 2 that are expecting 4 to increase. And he said he's also expecting a balance sheet to reduce throughout the year as well. And that was really the news of last week, which was released on Wednesday, and it was balance sheet reduction. They're calling it balance sheet runoff.
And what they mean by that is the way that they added stuff to their balance sheet is they print money and they go out and they purchase bonds. This is quantitative easing, and that means that they bought them, they're now on their balance sheet. So how do they get them off? They let the bond mature, which means that there's, let's say, $1 million note that's out there. They owe money to the person that's the bond holder. That $1 million is then given to the Fed because it's on their balance sheet, and that $1 million of cash comes out of circulation. And we've been here before. We could see that between 2016 all the way out to 2019, it was flat to beginning to taper and allow that balance sheet to roll off. And it was a slow drop. That's what we expect now. But then look at what happened. They had to then begin quantitative easing. I don't know if you remember the tweet storms from President Trump at the time, who was very upset about Powell not letting interest rates, or wasn't decreasing them. Granted, Powell was brought on as kind of this Taylor rule, didn't make judgment, let the data drive them. Well, President Trump won on the interest rate discussion, and they began to start raising lowering the interest rates, which means expanding their balance sheet. And then we get into the COVID crisis, and we can see the expansion of the balance sheet since then is quite dramatic, well more than what they were letting roll off. I think it's going to be the same situation here. It's going to start to taper, start to roll off. There's not going to be any.
They're unlikely to hit the market and start selling bonds.
Right.
They've purchased all these treasuries across the yield curve, so some of them are going to mature in the next year, and they're just going to reduce the money supply by getting paid that cash, right? And
the yield curve I think is an important statement, because they are saying that they're going to target the steepness of the curve, which is what we talk about. And all that means is what's a 1-year bond that's maturing versus a 5-year versus a 10-year. They're going to try to keep the low end or that short end, short maturities low, while allowing that long end of the curve to steepen or actually increase. That's where they're going to allow that debt to roll over, and then they'll probably use some proceeds. It'll be interesting on how they do it. So does that mean that we're going to have a correction now that the Fed is going to taper? Historically, no. If we look here, we can see each of the gray bars are when the Fed begins to raise interest rates up until the last time they raise interest rate. Now, if you were a good market timer, you would always sell on the last interest rate hike, because the first interest rate hike does not mean that the market's selling off. Historically, it's a nice run up. One reason is they usually don't raise interest rates unless the economy is in good shape. Things are moving. Maybe inflation's there because things are heating up. So the first rate hike tends not to be the one that you want to go out and sell the market. You want to sell the last rate hike. Now the problem is you'll never know which one's the last one, because the last one is the market finally gives way and the Fed begins to reverse that policy. But when we look back, whether it's 2004 all the way up to 2008, raised rates, nothing changed. Same thing going into 2000. It's not until afterwards that we see the market sell off. And the lines are not narrow. They're pretty thick. So we have time to make these changes.
And this was not consensus. It was just a few members on the committee that said, this is they see it as a probability, but we don't know exactly how many, but it was certainly not the majority. And that's why it was new, right? We didn't hear about this in December at the press conference. It came out with their news release where they talk about what was actually discussed.
And I'm sure it's the transitory inflation that has really changed. That those high CPI headlines are really what's driving this and why the market expects them to begin easing. So then, if we're looking at the yield curve here, shorter date maturities all the way out to 30-year bonds, and we can look. Well, we're not 2013, where a 30-year bond's paying you 4%. But we're also not where we were in August of 2020, where it was paying 1.19. So we've moved up, and we're going to look at how that has affected the interest rates over the last year or so. But we're at 1.9 at the time of this image. Yeah. We've certainly moved up since then. Beginning of the week, we started out near 2% on the 30-year, which is a big movement for such a short time frame. Where do you think we're going to end up?
We originally, heading into the year, our forecast was for the 10-year Treasury yield to be around 2.25 to 2.5. That was about a 100 basis point increase from where it was. Well, we've already seen a 20 basis point increase in the last,
and that's the market. So. That's just the market. That's not the Federal Reserve acting yet. This is the market front running what they anticipate them doing. So then, where are we at in our projections?
We're not expecting the rates to go as high as they were in 2013, but really closing that gap almost roughly short between there, about 2.25 to 2.5 on the 10-year and a little bit higher on the 30.
And when we're seeing the market disruptions, I think a lot of people are concerned that there's a bear market or a technical correction going on, and we never know. But whenever we look at really how the asset classes are moving, it's more the growth side that's selling off, and the value side is holding up. The movement that we've seen in the market the last few days, I would say, is more the interest rate getting priced into valuations for stocks, which we've talked about before. So this is not, so far, based off the data, is not we're moving into a technical correction or at a high probability of a bear market. Obviously, data can change, and we'll change our opinions as that data changes. But right now, stay the course, even though it is fairly volatile. Now, what about fixed income investing?
So that's a common grid we've seen a lot. We usually talk about it with equity, where it's size and growth versus value. But in fixed income, it's credit risk on the vertical axis, and horizontal is interest rate risk. So how much is your bond going to get hurt if rates increase? And like we've been saying, we want to stay short on that yield curve, which is why our bonds are in that low to moderate interest rate risk.
So if we're looking at the ag benchmark, that duration is, I think it's at 6.6. 6.6. So we're at 2.5, a lot less interest rate risk. So that means if interest rates increase, you're less likely to see a big impact on the price of your bonds, less likely to see negative numbers. And then the effect of maturity, they're often related. We won't get into the fancy math that you have to do to basically back that out, but the maturity is much longer on the ag. Right. So what we're trying to do is say the point of a bond in a portfolio, the primary reason is to act as a ballast in a portfolio. And if we're having negative numbers because the interest rates are moving up and they're moving up quickly, then bonds are no longer acting in that way. So we want to look very similar or closer to cash than, let's say, the benchmark ag. And that actually helped us a lot last year.
And a lot of domestic bonds too, right?
Yes.
International bonds last year, global bonds, were down anywhere between 7 and 10%. While we were down about 1.5%. Our portfolios were about flat on the fixed income.
We had a slide in here, and I pulled it off. I apologize, but it did show just where we were, like you were saying, -1.5 for U.S. Treasuries or U.S. the U.S. ag,
which is about 40% Treasuries.
Yes, which is a very conservative portfolio. But then we saw things that were international, Europe and others, down near 10%. Well, that's near technical correction of equities. That's not providing a ballast. So really looking at this and staying U.S. domestic, staying short on the curve, that's really helped us out on fixed income so that it's providing a ballast. So let's get to our investment themes. Continue to say inflation risk is high. It'll be interesting. We get the CPI numbers this week, don't we? So it'll be interesting to see those numbers and see what's happening. Now, one thing that we mentioned in our previous call is 11 of the 12 months are already baked in. It's high. So they're going to announce headline CPI I'm sure it's going to be well over 6%, even if we're flat for the month, just the way that the data is. What we're going to want to look at is the month and then annualize that or project it out going forward. That's going to be the tell on whether inflation is going to remain high 12 months from now with the index. Continue to favor equities over fixed income despite the volatility. Why? Because this interest rate movement is going to cause stocks to move down further than bonds, but bonds are moving down as well. We're just repricing them. But the issue is whenever you have that new discount rate into equities, they now grow at a faster pace. And you're basically able to get some return with the risks that you're taking, where I like to call bonds really just a return-free risk at this point. They were negative for the year, and look at how well the equities did. Now, we favor the U.S. domestic equity still. We continue to look out there. Demographics are usually the bearish story, whether that's in Europe, Japan, and even China. There's a lot of issues. We like some places in emerging market. Just we think China's domestic economy is going to struggle year going forward. Favor technology, but dial back PE. That's a new statement for us that we have in here. You want to talk a little bit about that?
We talked a little about last week, and by dialing back PE, we're just putting a focus more on equities that are returning more earnings closer to today instead of out in the future 10, 20 years from now.
Right, because the higher that your price to earnings is, that's really projecting out earnings further out in the future. And as that interest rate moves up, it has a bigger impact the further those earnings are out. So knowing that we're going to be in a rising rate environment, we're just trying to pull some of that PE back so that there's not as much impact. Still like growth stocks though. Bearish international as well as China, talked about that earlier. And then when we look at price points, this was as of Monday, so we dipped just below that 50-day moving average, which we've done many, many times. I think we did it 4 or 5 times last year, so that's not to be expected. If we're at below 4,568 on the S&P 500, that's a new low, and it's kind of breaking the recent trend of just dipping below the 50-day moving average. And if we're below that 200, I think that would be concerning. I don't expect that, just some volatility here as we go into a rising rate environment, and then the equities will eventually come back. Now, have any other thing to say for the quarter? Well, we really appreciate you tuning in. Normally we do performance here. We're not going to go over that now. Usually we will take care of that on our live call. So if you're not getting the performance and following, that's because you're not tuning into the live call. Make sure you reach out to your lead advisor so they can get you on the invite so that you can get the live calls and get that performance. Really appreciate you joining. If you haven't subscribed yet, go ahead and hit that subscribe button and share the video if you can. We'll see you next week.